you then get a group of people together who have got a different expertise, different skill base. So you actually get resources of multiple people come together and do due diligence in it.
As the private capital markets continue to open up to more and more people than at any other time in history, individual investors now have access to a broad range of private companies to invest in. Now, if you're the kind of person who wants to do your own due diligence and to pick and choose companies that suit your particular investment mandate, you can already do that on the VentureCrowd platform today. But if you're looking for a diversified portfolio of high quality private companies where the due diligence and assessment process has been done for you by a experienced group of angel investors, then we're thrilled to be able to offer you the opportunity to participate in the Sydney Angels Sidecar Fund number 3. For more information, jump onto the VentureCrowd website or stick around. I'm going to have a chat to Adrian Bunter, one of the investment committee and management committee members and my good friend from my PwC days. Yeah, there's so much growth in that. We'll just edit that bit out. You've triggered the alarm at the Opera House.
In fact, I think there's the SWAT team coming in. That's a boat that can go much faster than that. Like, get out.
So Adrian, you are an investment committee member and a management committee member of Sydney Angels, but you're also one of Australia's most experienced corporate advisors. Tell us how you ended up here, what's your professional background, how did you end up at Sydney Angels, and what's your role in the fund?
Yeah, thanks, Steve. What's really interesting is my interest in Sydney Angels and the fund probably started way back in the late 1990s in the original .com1 days when I was actually working with a whole lot of private companies and startups, helping them raise capital and do transactions. That evolved to me actually joining Sydney Angels in 2008 as Sydney Angels was forming as an organisation, and I started investing around that particular time. So basically been investing in startups with Sydney Angels over about 14, 15 years, and through that time we've also been advising mainly technology companies on M&A transactions, capital raising and buying other companies. So that's sort of where my interest has come from.
And prior to that?
Was a PricewaterhouseCoopers, originally a chartered accountant where we first met. And really started really dealing with private companies all the time. So I've always been super excited by that private small company taking on the large, that David versus Goliath battle. And I really get enthusiastic and interested in supporting companies to do that.
Yeah, that's interesting. I mean, that's a natural segue to sort of the next question, which is around the macro. What we're seeing at the moment is the public markets in decline, the fastest rate of decline in 25 years, with less and less companies listing and more companies choosing to stay private, not just longer, but private period. And the corollary of that is also true, which is the private capital markets on the incline, expected to continue to grow $8 trillion by 2030, driven not just by institutions and family offices, but driven in large part by ordinary investors, the emerging affluent, the mass affluent, people who aren't necessarily wholesale, but are looking to private market assets like private companies, startups and scale-ups for diversification, for growth, for value accretion in a way that you just can't get in the listed markets today, and certainly if the trend continues into the foreseeable future. What's your view on what's driving investment into private companies, into startups and scale-ups? What's your view on the macro?
I think there's absolutely a component of what you said around that diversification around the really large company. I think if you look at almost any large company today and design it from scratch, you would probably never design it that looks like the company as it is today. Yeah. So the startups coming through are actually looking to innovate, they're actually looking to do things better, and people talk about doing things 10 times better and 10 times cheaper. So a small company, because it's coming off a very small base, can always grow much faster than the size of the economy and much faster than a large corporate can be, and actually add value to consumers. So in a tough economic environment, people are always looking to save money, do things better, do things cheaper, and startups are very, very well placed to actually do that. So I think that's one of the things that drives it. And I think people get bored with really large asset classes, with property. They know when they're investing in a startup, they're making a genuine difference on improving things. They're actually driving employment growth. So I think all these things sort of compound together that drive people to be interested in private markets and startups in particular.
There's so much growth in that period between seed all the way through to Series A and Series B in a way that I think the larger institutions really, really struggle with, will always struggle with, not through any sort of criticism of the way large institutions are organised, but simply through the fact that businesses that have been around for a long time, who've cobbled together different technologies over decades, then are bound to legacy systems, which are very, very difficult to turn around. And even when we talk to some of the largest financial services businesses in the country, who I won't name, we talk to their technology teams, they say exactly that. So we've got these little divisions inside these technology teams desperately trying to innovate, but the problem is not so much whether they can, whether they've got the talent, whether they've got the finances to do that to conduct that kind of innovation, but whether then you can integrate it into something like a major bank, which already has in place so much legacy, many systems, so many levels of hierarchy that it's almost impossible to do. Which means if you're looking for that kind of innovation, you kind of have to go to startups and scale-ups.
Yep. No, I think that's exactly right. Like every single large corporate has got a way they do things, and that's been drilled into the systems, the people, the processes, in many cases for multiple decades.
Yeah.
And it's very, very difficult to change that, to change the systems. They're large behemoths. The culture of that organisation is not often one that's driven by strong innovation. There's a lack of incentive for people to actually try new things and actually take risks on things, which means innovation is coming from startups.
Yeah, it has to. I mean, quite often the challenge that startups have is convincing somebody potentially whose role becomes redundant off the back of your innovation that they should consider using you. I mean, that's always going to be a challenge. So let's talk about the value accretion potential of a company in that early stage and that mid stage. Sydney Angels has a solid track record of investing in some of the best high-growth private companies in the last decade, one of which I think reached a return of 50 times cash invested. Tell us about some of those exits and the scale of them and the potential of it for investors who may not be familiar with venture capital style returns.
Yeah, look, Steve, I think there's been some fantastic returns. So Sydney Angels has got quite a wide portfolio that's come through, about 90 companies so far to date, about $41 million invested. But some of the ones you're talking about, so Clarity Pharmaceuticals is probably one of the standout companies in the portfolio. So from the original seed round investment, when it came through Sydney Angels to the time of the IPO, at the IPO price, that was about a 50 times return for investors.
It's amazing.
It is amazing. What's actually more amazing is those investors who continue to hold on after that have seen the 50 times go actually into over 200 times return in that. So you've gone from a company at the very early stages to now be worth over a couple of $1 billion, an absolute market leader on the stock exchange. But one single company doesn't make a great return. Actually, in fact, in this case, one single company does make an actually spectacular return and pays for every single other company if you were to invest and spread it across. But we've also had companies like Instacluster, which got sold in a transaction worth about $700 million to a US listed company. That company from seed round to the exit was about 40 times return on that initial investment. And there are multiple companies that have done multiples of returns from actual exits, but ones that are still continuing to grow. So you've got companies like Edrolo, which are sitting at 20 to 25 times return from original investment. Through to smaller ones like Ortra, which actually exited within about 2 years at about a 4 times return on investment. So a smaller multiple, but actually a really, really high.
4 times return is.
It's still, I think it was a 93% internal rate of return.
Yeah,
so again, pretty spectacular investment. It sure beats the interest in the bank.
It sure does. It sure does. Okay, so let's talk about risk. Obviously, these are the standout opportunities. They are the kinds of investment returns that are possible in the startup and scale-up space. But how should people think about risk, and how do you think about the mitigation of risk?
Yeah, it's a really good question. So, startup investing is absolutely high risk. At the earliest stages, you're going to expect a large percentage of your portfolio to actually fail or lose money. And as a result of that, the way to mitigate that is to actually be highly diversified. So you can't put all your eggs in one basket. You've got to actually look at a range, a broad cross section. So you want to invest in a range of companies across a range of different sectors, a range of different time sizes, time frames and scales, and make sure you've got a decent portfolio in that. So you can either do that by picking and being very hands-on and very active, and it's actually quite an intensive process. Or you could also invest, as we're talking about the Sydney Angels Sidecar Fund 3, in a fund structure which actually gives you that built-in automatic diversification.
So let's talk about that, because as the private capital markets continue to open up to more and more people than I think at any other time in history, we're seeing more and more individual investors wanting to have exposure to private companies. Now, for some of them, they're quite keen to do their own due diligence. They have specific interests in specific sectors for whatever reason, either because professionally that is their background, or they have a particular connection with a problem, whether it's cancer or diabetes or something else that's quite personal. For others, though, they do want diversified exposure and they rely on due diligence. That is one of the benefits of the fund. Can you talk us through the due diligence process and assessment process that has been built inside City Angels over, I want to say, a decade now?
14 years.
14 years. So tell us about that. How does that work, and why should people feel comfortable with that process?
So Sydney Angels is a membership-based organisation. We have about 100 members. And that sort of goes up and down a little bit, but it's fairly constant around that 100 members. So we run 6 cycles a year where companies apply to raise capital. In each one of those cycles, they have anywhere between 40 and 70 companies apply and submit their applications. Those then get filtered down by a committee, a combination of the committee and some members, to what they think are the best 6 deals out of that cohort. Those top 6 deals then go and pitch at a deal screening meeting, which is made up of about 15 to 20 people. They then vote on those 6 deals to work out what they think are the best 3 deals. The best 3 deals then go and pitch to a full members meeting. And it's a standard 10-minute presentation, 10-minute Q&A, we then have a conversation around it. At that members meeting, syndicates form based on their interest in those deals. So that syndicate is then made up of a group of people who've got a diverse skill base. So you'll have former entrepreneurs, you'll have people with legal and IP expertise, you've got finance people, you've got marketing people, you've got IT people. So that syndicate forms and you get a multiplication of minds and people actually working through problems. And they go through then a due diligence process, negotiate terms, understand the entrepreneur, understand the business, the opportunity, and then progress and ultimately make an investment or not in one of those companies.
And let's connect that now to the fund.
Yep.
So tell us about the way the fund, what is the fund's mandate specifically, and what is the criteria for the fund to make an investment in one of those companies?
Yep. So the fund, the Sydney Angels Sidecar Fund 3, is a fund that co-invests alongside Sydney Angels. So what it does, it has access to all of the deal flow that comes through Sydney Angels. So in the event that a Sydney Angels syndicate forms around an opportunity and then invests in that opportunity, the Sidecar Fund will co-invest alongside that, so long as the investment committee is comfortable that an appropriate due diligence process has actually been followed through that. So what it normally requires is at least 3 members have to commit and invest, and there needs to be a minimum investment of about $50,000. But what you'll tend to find is those first round investments are somewhere in the range of sort of lower end 100,000, but up to about 250,000. Normally around that 150 to 250K is a first round investment that individual members will make. So the Sidecar Fund would co-invest that same amount in that first round.
Got it. Final question then. So one of the major benefits of the fund is actually its structure. It's structured as an early stage venture capital limited partnership. For those people who don't know why that is of benefit to investors, Adrian, talk us through it.
So an ESVCLP is really attractive to investors. It's got sort of probably 2 core key benefits. The first one is all the returns that you get out of it are tax-free. And who doesn't love tax-free returns? The second benefit is you actually get a 10% tax credit on all capital originally invested in it. So if you were to put $100,000 into it, once that $100,000 invested, you're going to get a $10,000 rebate on your tax bill. The $100,000 will grow. When you make a gain, tax-free as well.
Beautiful.
It is beautiful.
So this is the 3rd Sydney Angels Sidecar Fund. Number 1 and number 2, talk us through their portfolios, and how does Sydney Angels Sidecar Fund number 3 benefit from the fact that there's already two funds in place with existing portfolios that I guess the committee knows well?
Yeah, that's a good one. So the first Sidecar Fund was at the very, very final stages. So the companies that are in there are effectively in exit phases. So it had Clarity Pharmaceuticals, Instacluster, still got Simply Wall Street, had some great companies in there. Sidecar Fund 2 has finished its initial investment stage. There's a portfolio of companies in Sidecar Fund 2. One of the key benefits of Sidecar Fund 3 is that it also gets access to follow-on investments that come from earlier companies in the portfolio. So sometimes there's some really great benefits in that The investors know the companies really, really well. We've actually got a much longer track record in understanding those companies and the traction they've got. So I talked about the opportunity to get diversification around timing. So you can also get some slightly more advanced opportunities that are potentially going to be faster towards exit around that.
Yep. So let's start by talking about Sydney Angels as an organisation. Just tell us how it started and how it's built over time, and what is it today?
Yeah, so Sydney Angels is actually a not-for-profit organisation aimed at building a network of angel investors, really to go and back startups. Started back in 2008, group of volunteers got together. Sydney was actually one of the last cities in the country that didn't have an angel, have an angel group. And it was actually about bringing together, coming out of the GFC, about this opportunity to invest in startups. So it's now grown to about 100 people. The committee is a committee of 10. It's a volunteer. We meet every single Friday morning to actually go through and help develop the organisation and actually continue to make things run smoothly. And there's a vision for Sydney Angels ultimately to back and continue to help Sydney and actually the east coast of Australia and all of Australia support and find new startups to actually grow. And we've backed startups from actually all around the country.
Yeah, there's so much growth in that. We'll just edit that bit out. Cash invested. Segue to.
Supposedly there's a report of people standing on steps at on the Opera House.
You've triggered the alarms at the Opera House. I do love this.
That's a boat that can go much faster than that. Like, get out. The one hazard of filming outdoors in public areas.
I know, it feels like a good idea, but up an entire portfolio is.
That kid wants to get into angel investing.
Sign him up, Adrian.
In fact, I think there's the SWAT team coming in. The old freshwater ferry.
Don't quite realise how efficient our transport system is until you have to make a video on the harbour.